where did this all begin, and what is the first sign of the banking turmoil? Now, I would request Mr. Rishi Raj Singh, who is our operations manager, to introduce the topic of the collapse of the Silicon Valley Bank. So, what exactly does Silicon Valley Bank do? Where is it located? And what is the entire scenario with respect to this? So, I request Rishi to connect the Jenga by explaining to us.
So before I start, my piece is not as descriptive as Arushi's. So it's a little more concise. I hope everyone finds it a little helpful. So, like Shreya said, I will be discussing the Silicon Valley Bank, its history, and the factors leading to the collapse. So let's start with the overview of the bank. Silicon Valley Bank, or SVB, was founded in 1983, and it was the 16th largest US bank before its collapse. They specialized in financing and banking for venture capital backed startup companies, mostly technology companies. SVB provided finance for about half of all the US venture-backed technology and healthcare companies. This was a preferred bank for the tech sector simply because the other banks would not accept the higher risks which come with this niche. I'm sorry, niche sector. So the first branch of SVB was based in Silicon Valley in California. Uh, their primary focus was to support emerging technologies in the Silicon Valley region. In 1995, Silicon Valley Bank shares, which is the parent company of SVB, went public with an IPO. Uh, an interesting fact about SVB, during the dot-com boom, SVB had provided financing to many technology startups and emerging companies. However, when the dot-com bubble burst, numerous businesses failed, resulting in a significant increase in loan defaults. This led to a surge in non-performing loan on SVB's balance sheet and substantial losses for the bank. So SVB has faced large downturns in the past, through which they recovered by strengthening their risk management strategies and expanding their service beyond the traditional banking and added services like FX services, investment banking, and asset management. Despite the challenges that they had faced during the dot-com bust, SVB managed to maintain its position, but even though they had been through such a phase before, they could still not recover of what happened earlier this year. So, very quickly, talking about why did SVB collapse? Just a precursor to their failure, SVB recorded 6 straight quarterly losses as the economic conditions turned unfavorable for them. The collapse happened for multiple reasons, including a lack of diversification and a classic bank run, where many customers withdrew their deposits simultaneously due to the fears of the bank solvency. Now, talking about the bank run and why did that happen? When SVB announced their 1.75 billion capital raising on March 8th, people became alarmed that the bank was short on capital. Word spread quickly on social media accounts such as Twitter and WhatsApp, which induced panic that the bank didn't have enough funds, which basically led to SVB stock plummeting by 60% on March 9th after its capital raising announcement and was made. Which basically led to customers starting to withdraw money in waves. Uh, People say that the bank run was Twitter fueled. Unlike personal banking, SVB's client had much larger accounts. Most customers had deposits more than 250,000, which was the FDIC limit. It didn't take long for the money to diminish during the bank run, which escalated the pace of withdrawals, causing a snowball effect and the bank to shut down. Another factor, which was I would say, one of the main factors, is the lack of diversification. Silicon Valley Bank invested a large amount of bank deposits. I'm sorry. Okay, sorry about that. So yes, talking about lack of diversification, SVB had invested large amount of bank deposits in long-term U.S. securities. However, the bonds and treasury values fall when the rates increase and vice versa. Now, the bank used to lend out money in short durations. However, in 2021, they shifted to long term securities such as treasuries for more yield, like I mentioned, and they did not protect their liabilities with short term investments for quick liquidations. They were insolvent for months because they could not liquidate their assets without a large loss. And when economic factors hit the tech sector, many bank customers withdrew money as the venture capital started drying up. And SVB didn't have cash on hand to liquidate these deposits because obviously they were tied up in the long term investments. They started selling their bonds at a significant loss, which caused distress. And like I had mentioned, upon the release of the news within 48 hours, I'm sorry, within 48 hours of the news, the bank had collapsed. So, who was affected by the collapse? It is SVB stockholders and investors. They took a big hit because, unlike customers, they were not backed by FDIC on their investments. Other issues include a lack of money from deposits for immediate expenses such as payroll. Large companies with significant cash in SVB, including HC, Roblox, Rocket Labs, and Roku, were affected as well. Uh, and if we talk about the takeover, what happened later, soon after the collapse, FDIC announced that the First Citizens Bank will purchase Silicon Valley Bank and assume the majority of deposits and loans. They bought out 72 billion worth of assets at a discounted rate of just $16.5 billion. The UK arm of SVB was bought out by HSBC. That's about it. I would like to finish my topic with a question for everyone who's speaking and who's attending. Uh, who do you think was at fault? Was it SVB who had their asset invested in US government bonds, which is as vanilla as it gets for investments, or is it the Fed who kept raising the short term interest rates to curb the inflation, which in fact could have been pursued in a much less draconian fashion? Thank you.